The DOJ and SEC are conducting investigations into SVB's collapse to determine if there was any misconduct or fraud by the bank's senior executives or board members. They are looking for evidence of insider trading, false or misleading statements to investors, accounting irregularities, or violations of banking regulations. They may also seek to recover any losses suffered by SVB's shareholders or depositors. The investigations are being led by the U.S. Attorney's Office for the Northern District of California and the SEC San Francisco Regional Office. They have issued subpoenas to SVB and several of its executives and board members, requesting documents and testimony related to the bank's financial condition, risk management practices, interest rate exposure, deposit outflows, securities sales, and communications with regulators and investors. They have also interviewed some of SVB's former employees and customers who may have information about the bank's operations and activities. The investigations are expected to take several months or longer to complete. The DOJ and SEC have not announced any charges or arrests related to SVB's failure. However, if they find evidence of criminal wrongdoing by the former CEO or any other SVB executives or board members, such as insider trading, fraud, conspiracy, or obstruction of justice, they may seek to indict them and bring them to trial. The penalties for such crimes could include fines, restitution, and imprisonment. Alternatively, they may reach a settlement or plea deal with the former CEO or others involved in exchange for cooperation or admission of guilt. The majority of the public believes that former CEO Greg Becker should be held accountable for his role in SVB's failure, and face criminal charges if he committed any illegal acts, such as insider trading, fraud, or obstruction of justice. They argue that he misled investors and regulators about SVB's financial condition and risk exposure, and that he sold millions of dollars worth of SVB shares before the bank's collapse. They also criticize him for paying bonuses to employees hours before the bank was shut down by regulators the majority of the time. The CEO of a failed bank does not get arrested but pays a fine or reaches a settlement with regulators or prosecutors. However, there are some exceptions where CEOs do face criminal charges and possible imprisonment for their role in bank collapses. In 2008, after the collapse of Lehman Brothers, a major investment bank that filed for bankruptcy amid the global financial crisis, no senior executives were arrested or charged with any crimes. The Justice Department investigated Lehman Brothers for possible fraud or accounting irregularities, but did not find sufficient evidence to prosecute anyone. In 2010, after the collapse of Washington Mutual, a large savings and loan association that was seized by regulators in 2008 amid the subprime mortgage crisis, its former CEO Kerry Killinger and two other executives were sued by the FTC for negligence and breach of fiduciary duty. They reached a settlement in 2011 and agreed to pay $64.7 million. Most of which was covered by insurance. In 2011, after the collapse of Taylor Bean & Whitaker, a mortgage lender that was shut down by regulators in 2009 after a $3 billion fraud scheme that contributed to the failure of Colonial Bank, its former CEO Paul Allen was arrested and charged with fraud, conspiracy, and making false statements. He pleaded guilty and was sentenced to 40 months in prison in 2012, after the collapse of MF Global, a brokerage firm that misused customer funds and faced a liquidity crisis. Its former CEO John Corzine was sued by regulators and customers but not criminally charged. He reached a settlement with regulators in 2017 and agreed to pay a $5 million fine and be banned from trading commodities in 2014 after the collapse of Bank of America, a major bank that faced massive losses and lawsuits related to its acquisition of Countrywide Financial and Merrill Lynch. During the financial crisis, its former CEO Kenneth Lewis was charged with fraud by New York Attorney General Eric Schneiderman for misleading shareholders about Merrill Lynch's financial condition. He reached a settlement in 2017 and agreed to pay $10 million without admitting or denying wrongdoing in 2018. After the collapse of Wilmington Trust, a regional bank that was acquired by Manti Bank in 2011 after disclosing huge losses on bad loans, four former executives were convicted of fraud and conspiracy for hiding the true amount of past due loans from regulators and investors. They were sentenced to prison terms ranging from 3 to 6 years in 2019, after the collapse of Wells Fargo, a large bank that was involved in multiple scandals involving fake accounts, unauthorized fees, and mortgage fraud. Its former CEO John Stumpf was fined $17.5 million by regulators and banned from working in banking. He was also charged with fraud by federal prosecutors but pleaded not guilty in 2020, after the collapse of Capital One, a major credit card issuer and bank that suffered a massive data breach that exposed personal information of more than 100 million customers. Its CEO Richard Fairbank was fined $637,950 by federal regulators for violating antitrust laws, by failing to report stock transactions associated with his compensation package over 2 decades in 2021, after the collapse of America Bank, a Birmingham-based bank that was seized by regulators in 2020 after suffering heavy losses and liquidity issues. Its former CEO Donald Watkins Sr. was arrested and charged with fraud, conspiracy, money laundering, and tax evasion. He denied any wrongdoing but was found guilty by a judge in 2021. The realistic outcome of the DOJ and SEC investigation into SVB is hard to predict, but people may have different opinions on what they want to see happen after SVB collapse. Some people want to see more accountability and transparency from the bank executives who sold stock before the collapse, and may have misled investors and regulators about the bank's financial health. Some people want to see more regulation and oversight of the banking sector, especially for banks that are exposed to risky assets like crypto or long-term bonds. Some people want to see more support and protection for the bank customers, especially those who had deposits above the FDIC insurance limit of $250,000, or those who relied on SVB for their business operations. Some people want to see more stability and confidence in the financial system, and hope that the government's emergency measures will prevent more bank runs and failures. Stay tuned for more content as more information comes to light on this topic.